Today, property signs for the 19th of July 2021. Hello again, it's Martin North from Digital Finance Analytics, working at this post covering finance and property news with a distinctively Australian flavour. In today's show, we looked further at the recent rent rises, New South Wales rules for seeking rent relief during the lockdown, where it's important to understand the small print, CBA offers yet more COVID relief, risks of interest rate rises, and latest draft legislation on the compensation scheme of last resort, and ASIC's consumer-centric approach to designing and distributing products, despite the fact that it's been changed without notice. So let's get started. As reported in the New Daily, national rents reported their fastest annual growth in more than a decade last financial year. Data released by CoreLogic shows that national rents soared 6.6% as the economic recovery beat expectations and record amounts of government stimulus flowed into the Australian banking system. House rents increased in all capital cities over the financial year, and unit rents rose in all capital cities except Sydney and Melbourne, which were both affected by an oversupply of apartment and a lack of migration due to international border closures. But the largest rent hikes were seen in regional Australia. CoreLogic says the regions reported annual rental growth of 11.3% over the past 12 months to June, the fastest rate since records began in 2005, and one that far outpaced the 1.5% growth in wages over the 12 months to March 2021. CoreLogic head of research Eliza Owen said the rapid hikes followed a subdued rental performance through much of the 2010s and had been driven by many of the same factors behind the current upswing in house prices. These factors include increased government stimulus through COVID-19, accumulated household savings through the lockdown periods, the swift economic recovery seen as restrictions eased, and a lack of rental supply in some markets, which have also exacerbated rental price increases, particularly in major centres of regional Australia. As with house prices, the pace of rental growth nonetheless slowed over the June quarter. National rents increased by 2.1% over the 3 months to June 21, compared to growth of 3.2% over the March quarter, with Ms Owen attributing the slight moderation to growing affordability constraints, as well as a rise in rental supply as more investors returned to the market. ABS data shows that the value of new home loans for investors rose 13.3% to $9.1 billion in May, the highest level since June 2015. As rents continue to rise, Better Renting Executive Director Joel Dignam said some tenants were having to cut back on essentials to make ends meet. People have to cut back on other things that you wouldn't necessarily think of as being discretionary, Mr. Dignam told the New Daily. It depends on the scale, but it might mean eating less often. In an extreme case, it might mean having to go without medication, or maybe you can't pay for your child to go to a school excursion. It means the sorts of things that people should be able to afford as part of their lives become that much harder to afford. Mr. Dignam said the high rental costs reflected a market where tenants applying for properties face fierce competition and often had to offer more than the advertised rent to secure the lease. He said the excess demand also affected tenants with no intention to move, as many were less likely to ask their landlord to make repairs if they thought they could be easily replaced. We've heard from people who've put up with some concerning living conditions because they know that they can't move somewhere else, and the risk of alienating their landlord is too great, Mr. Dignam said. CoreLogic's data shows that Canberra is still the most expensive city in Australia in which to rent a home. The median rent there is $620 a week and is followed in second place by Sydney with a median of $582. The data shows renting is also cheapest in Adelaide at $430 a week and Melbourne at $444 a week. And it comes after separate research from CoreLogic found that servicing a mortgage was now cheaper than renting for more than one-third, actually 36.2% of Australian properties, up from 33.9% in February 2020. And let me underscore again, the rise in rental stress that we see in our data set absolutely confirms what we're seeing here. People are having to spend more of their income trying to find somewhere to live. And this is simply because housing policy has been off-key for at least a decade. Elsewhere, New South Wales has published details of the rental eviction moratorium, which is now in place until the 11th of September 2021. Residential landlords who decrease rent for impacted tenants can apply for a grant or land tax reductions depending on their circumstances. If you're a tenant impacted by COVID-19 and are unable to pay some of your rent or other charges during the moratorium period, you should contact your landlord to try to agree on a plan to repay that money. You're eligible for the restrictions on evictions if your household income has been reduced by 25% or more because you or a rent-paying member of your household either lost or had a reduction in income or employment due to coronavirus, or had to stop working or reduced hours due to coronavirus illness or carer responsibilities. During this time, a landlord can only apply for an eviction if they show they're trying to negotiate a rent reduction in good faith, they went through the rent negotiation process with New South Wales Fair Trading, it's fair and reasonable in that specific case. The restriction on evictions does not apply if the landlord is experiencing financial hardship, or you're behind with your rent and not affected by coronavirus, or you've caused serious damage to the property or injury to the landlord, agent or neighbour, or the property is being used for illegal purposes, or you've been threatened or abused by the landlord, agent or another person, or because the landlord is selling the property. So in a number of certain circumstances, you won't be able to get the relief. And if you cannot come to an agreement with your landlord, you can take part in the New South Wales Fair Trading rent negotiation process. To do that, you'll need to complete a rent negotiation application and lodge the application and supporting documentations online. Now, it's important to understand the difference between requesting a rent reduction, a deferral, or a waiver. Existing agreements between a tenant and a landlord about the waiver or deferral of rent payment will not be affected by the end of the moratorium and the transitional measures. A request for a rent reduction, deferral or waiver should be made directly to your landlord or agent. And it's important to know what you're agreeing to. A waiver means the agreed amount of rent won't need to be paid back, but a deferral means you will need to pay back the agreed amount of rent in the future. Any request for rent reduction will need to include your original household income, proof of your change in income due to coronavirus, such as a job termination or stand-down letter, the amount of rent you can afford to pay, and any income support payments you receive. There's a template from New South Wales Fair Trading that you can use when contacting your landlord to request a rent reduction. And if you do reach an agreement with your landlord, you should put it in writing, whether the rent will be waived, deferred, or reduced, the amount and frequency of rent payable, how long the agreement is for, the date the agreement will be reviewed, what happens when the agreement ends, a repayment plan if the rent is being deferred. And finally, remember, you can still be evicted during this time if you break the other conditions of your lease. So it's really, really important to read the small print. CBA has announced that it will extend its moratorium on home loan foreclosures as the banking industry comes together to help customers through lockdowns. Any customer who falls in arrears as a result of COVID lockdowns will be given until February next year before the bank acts on any foreclosures. That's an extension of the previous scheme that was set to last until September. Owner-occupiers who have a year's worth of timely repayments will be eligible for the support. We believe extending our freeze on any foreclosures will give those customers who are again impacted by COVID-19 more time to get back on their feet and reassurance that they can remain in their home this Christmas and into next year, said CEO Matt Common. Westpac has also extended measures designed to help lockdown-affected customers, with SME clients now able to receive interest-free cash flow assistance from the bank. Small businesses can access overdrafts of up to $15,000 for a 6-week period, a move that should be able to help them long enough for government assistance to kick in. We know that the current lockdowns means some of our small business customers may need urgent access to cash, said Westpac CEO Peter King. We've introduced a new interest-free overdraft to act as a bridge to when government payment flows in, helping small business owners to cover urgent expenses during this time. And last Friday, Anna Bligh, the CEO of the Australian Banking Association, announced a national support package for small businesses impacted by the lockdowns in New South Wales and Victoria. 3-month repayment deferrals, terminal fee refunds, and fee waivers were just some of the measures introduced. As the lockdowns get worse, customers can rest assured that their banks will have their back, said Bligh. Today's announcement in New South Wales means more businesses, construction workers and traders will be unable to work in the coming weeks. If they are struggling financially, the best thing they can do is to call their bank. Throughout the pandemic, Australian banks have worked with government to support those most affected. They're determined to see customers through the worst. National employment figures dropped below 5% in June despite lockdowns in the 2 largest capital cities, fueling speculation the RBA may move on interest rates sooner than expected. Data released by the Australian Bureau of Statistics last Thursday revealed the unemployment rate had dropped by 0.2% to 4.9%, with the economy adding 29,100 jobs over the month. But the underemployment rate rose 0.5% to 7.9% over the period as workers had their hours cut due to lockdowns in early June in Melbourne and late June in Sydney. The new figures mark the 8th consecutive month in which the unemployment rate has fallen, but economists are fearful that a sustained lockdown in Sydney in particular could set back Australia's recovery from the COVID crisis. Commenting on the data, Van Eyck Australia Head of Investments and Capital Markets Russell Chesler said, with unemployment now heading towards a historic low, it was looking increasingly likely that the RBA could raise interest rates in 2022. June saw the 8th consecutive monthly fall in the unemployment rate to its lowest since December 2010. With indefinitely closed Australian borders and skills shortages mounting, we could see the unemployment rate fall towards a historic low, around 4%, notwithstanding the continued lockdowns in Sydney and potentially other capital cities, Mr. Chesler said. This will put upward pressure on wages costs and potentially push inflation closer to the RBA's 2% to 3% target band in 2022. Mr. Chesler said the prolonged Sydney lockdown may have a short-term effect, but it would not detract from the longer-term inflationary environment Australia and other global economies have found themselves in. Around the globe, inflationary pressures are building, and we have seen this week in the US, where CPI rose last month at the fastest pace since August 2008, up 5.4% from the previous year, and also in the UK, where inflation in June jumped ahead of consensus forecasts, he said. And elsewhere, the Morrison government last Friday released exposure draft legislation to establish the compensation scheme of last resort, as recommended by the Banking Royal Commission. The government has released for consultation new draft legislation to implement recommendations of the Banking, Superannuation and Financial Services Royal Commission. The legislation will establish the Compensation Scheme of Last Resort, the CSLR, as well as the Financial Accountability Regime. The draft legislation around the CSLR opens for consultation until the 13th of August and outlines the key features of the scheme, including the ability to authorise an operator of the scheme, eligibility requirements, compensation availability for eligible AFCA determination, the levying framework to fund the scheme, and the governance of the scheme. The financial products and services that are in scope for the CSLR are the same as those that are authorised to be provided by the Australian Financial Services Licence and ACL holders, who are required by law to be AFCA members. While credit activities undertaken by credit representatives are within the scope of the CSLR, credit representatives will not fund the CSLR as their authorising Australian credit licensee, the aggregators, are liable for their activities. The primary legislation for the CSLR will confer a power to make regulations to prescribe which financial products and services are within the scope of the scheme. And it's estimated that the ongoing levies for the credit intermediary subsector will be around $887,000. The main objective of the proposed CSLR is to provide a pathway for eligible consumers to receive compensation flowing from an AFCA determination in their favour, where the financial firm has not paid the consumer in accordance with the determination. The CSLR operates to create a pool of funds from which eligible claimants who have suffered loss or damage as a result of inappropriate action of a financial firm can access compensation, even if, for example, the financial firm has become insolvent. The government has put forward that the CSLR will encompass 5 financial products and services, including personal advice on relevant financial products to retail clients, credit intermediation, which is leverable to credit licensees that are authorised to engage in credit activities other than as a credit provider, credit provision, which is leverable to credit licensees that are authorised to engage in credit activities as a credit provider, securities dealing, and insurance product distribution. The CSLR will be administered by the operator, which is a company that meets the operator requirements and is authorised by the Treasurer. Under the scheme, a complaint that has been provided with a determination by the Australian Financial Complaints Authority will be able to seek the determined compensation up to $150,000 from the operator. In a joint media release for Senator Jane Hume, the Minister for Superannuation, Financial Services and Digital Economy, the establishment of the compensation scheme of last resort will support ongoing confidence in the financial system's dispute resolution framework by facilitating the payment of compensation to eligible consumers who have received a determination for compensation from the Australian Financial Complaints Authority, the AFCA, which remains unpaid. The financial accountability regime will extend the banking executive accountability regime to all APRA-regulated entities and will be jointly administered by APRA and ASIC. The financial accountability regime imposes a strengthened responsibility and accountability framework within financial institutions, recognising that decisions taken by directors and the most senior executives of financial institutions are significant for millions of Australians and the Australian economy. He concluded, the Morrison government remains committed to completing implementation of the Financial Services Royal Commission and in doing so ensuring Australians continue to have trust and confidence in a strong and effective financial system. Which is all very well, except of course that separately he's trying to remove the responsible lending obligations which are so critical and were also recommended by the Royal Commission to remain. And finally, there was no consultation on expanding the design and distribution obligations to home loans and other consumer credit products, a banking group has said. In a recent submission to the Senate Select Committee on Australia as a technology and financial centre, the Customer-Owned Banking Association, COBA, stated that various measures recommended by the Royal Commission into misconduct in the banking, superannuation and financial service industry have been legislated without a Regulated Impact Statement, or RIS. In particular, COBA Chief Executive Michael Lawrence addressed the expansion of the design and distribution obligations, the DDOs, regime to cover consumer credit and argued that this was a massive expansion that was not subject to a consultation process. The product DDOs for financial products, which takes effect on October the 5th, after being postponed from its original commencement date on April the 5th due to the COVID-19 crisis, were passed in Parliament in 2019 following a recommendation of the Financial System Inquiry. The obligations have been designed with the aim of helping customers obtain appropriate financial products by requiring issuers and distributors to have a consumer-centric approach to designing and distributing products and cover lenders and brokers. ASIC released a regulatory guide which explains which products fall under the DDOs and ASIC's interpretation and administration of the obligations. The guide states that DDOs require issuers of financial products, such as lenders, to consider the design of its product to determine whether an appropriate target market exists for it and who it might be. Issuers and distributors, such as brokers and other referrers, such as online broker, mortgage marketplace sites, etc., will also be required to distribute products in a more targeted manner. In the COBA submission to the Senate committee, Mr. Lawrence said that there was no public assessment or cost-benefit analysis undertaken, nor an RAS done, before expanding the DDO regime at the last minute to cover home loans and other consumer credit products. The amendments to cover the regime to include credit were rushed through under a guillotine. Debate in the lower house on the amendments lasted about 9 minutes, while debate in the Senate lasted for about 1 minute, he said. It appears many MPs held the view that the amendments would operate to implement recommendations made by the Financial Services Royal Commission. However, Mr. Lawrence said that Commissioner Kenneth Hayne did not recommend this policy to expand the DDOs, but rather asked a question about whether there was a case to extend the regime. The Royal Commission final report stated the design and distribution powers do not now extend to credit products. More significantly, for present purposes, those powers do not extend to financial products that are not regulated by the Corporations Act, but are regulated by Division 2 of Part 2 of the ASIC Act. The product intervention powers have a broader reach, but nonetheless do not extend to all ASIC Act products. It is not apparent why the powers should not extend, as ASIC has requested, to all financial products and credit products within ASIC's regulatory responsibility. Mr. Lawrence said that in COBA's view, the Commissioner's question is answered by considering the origins of the DDOs, which is in the Financial Systems Inquiry final report. He said the FSI, in supporting a DDO's proposal, focused on addressing detrimental consumer outcomes from large-scale financial investment failure and poor advice associated with complex financial products. There was actually no focus on credit products or basic banking products. And in its submission, COBA has recommended consistent and rigorous application of RAS processes to demonstrate a stronger commitment to adequately assess the impact of proposed regulatory measures. Mr. Lawrence noted that in the Financial Services Reform, the Hayne Royal Commission Response Bill of 2020, Explanatory Memorandum, it states that the final report has been certified as being informed by a process and analysis equivalent to a regulation impact statement for the purposes of the government decision to implement this reform. But, he said, COBA does not agree that the Royal Commission report can be a substitute for an RAS. The legislation introduced significant new obligations on banks in relation to breach reporting and new restrictions on product sales and interactions with customers, among other measures, Mr. Lawrence said in COBA's submission. The impact of these measures was not subject to an RAS, and the very substantial bill, with its multiple schedules, was not even referred to a Senate committee for review. Now, I think there's an important point here that there should be due process around significant changes like these. I think in theory, the concept of enforcing the design of products from a consumer perspective makes perfect sense, but nevertheless, from a due process perspective, I think there should have been consultation, which there wasn't. So I agree that COBA has a point, and it will be interesting to see whether the government listens or whether they just ram it through. They have a bit of a track record, really, of doing their own thing, never mind everybody else. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.